Hello, I am Merlin. Since Mithrandir is taking a well-deserved rest, I will be serving as your financial guide from here on out. Today, I am going to simplify the world of investment funds by breaking down four primary types: index funds, mutual funds, hedge funds, and ETFs. By the end of this session, you will understand how each functions, their respective advantages and disadvantages, and most importantly, which one aligns with your financial goals. Before we begin, please note that this presentation is for educational and informational purposes only. I am not a licensed financial advisor, and nothing here constitutes professional financial advice. Always conduct your own research or consult with a qualified expert before making investment decisions. Now, get comfortable and let's explore the world of funds. Section 1. What is a fund? To understand the concept, let's look at a simple analogy. Imagine you and your friends want to order pizza for a party. There are 4 different restaurants, each known for a specific specialty. One for pepperoni, one for vegetables, one for meat lovers, and one for dessert pizzas. You only have $20, which is enough for just one pizza from one place. If you choose poorly, you have wasted your money and everyone remains hungry.
So you ask 3 friends to contribute $20 each. Now, with $80 total, you can order one pizza from each restaurant. If one turns out to be disappointing, it does not matter. You still have 3 other delicious options. This is exactly how investment funds operate. A fund is a pool where your money is combined with that of hundreds or thousands of other investors. Instead of pizza, this pooled capital is used to purchase various assets like stocks or bonds. For instance, if a fund called Supergrow has $1 million, its managers might invest $200,000 into each of 5 different companies: Apple, Amazon, Google, Netflix, and Tesla. Each company represents 20% of the fund. When you invest $100 in Supergrow, your contribution is automatically spread across all 5 companies, meaning $20 goes into each one. With just a single purchase, you own a small slice of 5 major corporations. Section 2. The 4 types of funds. First, let's talk about mutual funds. Think of these as restaurants with professional chefs who decide what to cook based on their expertise. Mutual funds, which have been around since the 1800s, are the pioneers of the fund world. Professional managers actively research markets and decide which stocks to buy and sell to outperform the market. Because you are paying for this level of expertise, mutual funds usually carry higher fees, typically ranging from 0.5% to 2% annually. They often require a minimum initial investment of $500 to $5,000. Unlike stocks, which trade instantly, mutual funds only execute trades once per day after the market closes, using a price known as the net asset value, or NAV. Well-known examples include Vanguard's VP Max, Fidelity's FBGRX, and T. Rowe Price's TRBCX. Type 2 is index funds. If mutual funds are like restaurants with chefs, index funds are like buffets where the selection is already laid out for you. Revolutionized by Jack Bogle in the 1970s, index funds do not pay expensive managers to pick stocks. Instead, they simply copy a list of companies known as an index. The most famous is the S&P 500, which tracks the 500 largest U.S. companies.
Other indexes include the NASDAQ 100 for technology, the Dow Jones for established blue-chip companies, and the Russell 2000 for smaller firms. Because they are passively managed, their fees are extremely low, often ranging from 0.02% to 0.20% per year. Like mutual funds, they generally trade only once per day, but they offer broad diversification with great simplicity. Type 3 is ETFs, or exchange-traded funds. Think of these as food trucks. They offer similar food to restaurants but provide more flexibility. Created roughly 15 years after index funds, most ETFs are also passively managed. The key difference is that you can trade them in real time, just like individual stocks during market hours. They often have much lower minimum investment requirements, sometimes as low as the price of a single share. They also allow for advanced order types like limit orders and stop losses. Popular examples include VOO for the S&P 500, QQQ for the NASDAQ, and VTI for the total U.S. stock market. However, be cautious. Because you can watch prices change all day, some investors may fall into the trap of emotional, impulsive trading. Type 4 is hedge funds. These are like world-famous private chefs who use exotic ingredients and experimental techniques. They are private investment pools designed for aggressive strategies, such as short selling, using leverage, or trading complex derivatives. To participate, you usually need a massive minimum investment, often starting at $100,000 or more. They are expensive, typically following a 2 and 20 fee structure. 2% of assets and 20% of profits. Legally, they are usually restricted to accredited high net worth investors. Famous examples include Bridgewater Associates, Citadel, and Renaissance Technologies. Section 3. The Performance Showdown. You might assume that expensive, actively managed funds would outperform simple index funds. However, the data shows that 80 to 90% of active mutual funds and hedge funds fail to beat the market over a 10-year period. Beating the market consistently is incredibly difficult. Furthermore, fees quietly erode your wealth. For example, if you invest $10,000 for 30 years at an 8% return, an active fund with a 1.5% fee would grow to about $66,000. An index fund with a 0.05% fee would grow to nearly $100,000. That difference of over $30,000 is purely due to lower fees. To summarize, mutual funds offer professional management at a higher cost. Index funds provide broad market exposure at ultra-low costs. ETFs offer the benefits of index funds with the flexibility of stock trading. And hedge funds are high-risk, high-reward options for the ultra-wealthy. For most people, index funds or broad market ETFs are the most efficient path. Investing involves risk, so never put in more than you can afford to lose. If this breakdown helped you, please leave a thumbs up and subscribe for more finance content. Check out the video on your screen to learn about how stocks work, and I will see you there.